B on accounting treatment of transactions 2 and 3 above in LBA's financial statements for the year ended 31st December 2020. So here we just need to advise. But I'm not going to talk about note number 2. Here they are telling us that reserve banks entered into a 5-year lease of an automated teller machine with Matendo Shipment Limited, commencing on 1st January 2020. Okay. The automated teller machine had a useful life of 15 years. Okay, that is useful life. And they are telling you that Reserve Bank has spent shillings 20 million to transport the automated teller machine from MSL location to LBS premises. The cost of installing the machine, in LBS premises amounted to shillings 10 million. Okay. The legal costs incidental to the lease contract were shillings 5 million. The lease required LB to initially make rental payments. Remember, whenever you're reading this, you need to know now this cost will be applicable to where. In your mind, you should know how you're going to get lease liability and right of use asset. So if you're talking about a certain amount, you need to know this amount is applicable to what. Okay. So here they are telling you that there is required LB to initially make lease payments, to initially make rental payments of shillings 50 million per annum for the first 3 years, and shillings 30 million thereafter. Okay, due on 31st December each year. What does this one mean? It means that you're making a payment. If you see this, it means that you're making a payment after every end of the year. Okay? This is like in arrears. This is not in advance. Colleagues, these two words are very, very key, especially if you're going to determine the lease liability. You need to know when are you making the payment. Is it at the end of the year or at the start of the year? At the start of the year, that is in advance. At the end of the year, that is in arrears. Okay. The company incremental borrowing rate is at 15%. So you see 8 marks. So how are you going to start? Okay. So this is question 3. And not in question 3, May 2024. Not number. Is it not number 3?
Hello?
When you see in our question, we are writing a report. We are writing a report to the Director of Finance advising on what? On the accounting treatment. So if it is a report, you need to write the format. Okay. We are writing to the Director of Finance. Okay. So we are going to, which company is this? LB. Okay. So we are going to say that to the Director of Finance of LB, and this is from From who? The director of finance learned that the financial reporting team failed to account for the following and has now consulted you to advise. So here you don't have the specific title. So you're going to use CPA student. So from CPA student, a date, we can put the exam date or today's date. 23rd, let me put 23rd, 23rd April 2025. Then subject, what are you going to put? Subject, you're going to say accounting treatment. If you're handling that part B, accounting treatment of notes, okay? What they have specified of notes, from which note to what? Now for this one, it is from note number 2, it is 2 and 3. Accounting treatments of notes 2 and 3. So you can write something like an introduction and say, I have been engaged offer advice on accounting treatment of various transactions in the financial statements, in the financial statement of LB, of LB for the year ended. Here we are ending our year on which date? For the year ended the 31st December 2020. For the year ended the 31st December 2020. Okay, the advice is provided below. So you can start. Once you do this, you can start with any note. But for now, I'm going to handle note number. I'm going to handle note number 3, and this is about lease. Lease of which asset? It's lease of what? Note number 3, it's lease of an automated teller machine. So you can start with any note if you're doing this, okay? So from here, you're going to tell the examiner what is all about the standard, okay? You cannot simply just calculate. As we said yesterday, you can copy that very information that I gave you yesterday. Leasing creates, I can copy. Anyway, I don't have that document. Leasing creates lease liability. Lease liabilities and what? And right of use asset in the books of who? In the books of the in the books of lessee. In the books of lessee. in the books of the lessee. That is LB. Remember, you are in the books of lessee, the one who is using this teller machine, okay? You are not in the books of lessor. There is accounting treatment if you're in the books of lessor. It's different. It's different. But for now, let's stick on this. Okay. So this leasing will create lease liabilities and the right of use asset in the books of the lessee. Okay. Then you're going to say that IFRS 16, that is leases, requires the lessee to initially do what? Initially measure the resulting liability at present value and the right of use asset at what? Right of use asset at a cost as per appendix. As per appendix, you can bring your appendix. If it is appendix 4, you put appendix C4. But for now, it's appendix 1. Okay. Then you're going to say that this is initial measurement. The initial entries required to recognize the lease are okay. So you're going to pick these initial entries from your appendix. Okay. So you have to first talk about initial recognition. Okay. So I can leave a good space, like for you, you leave a page. Can leave a page, or if you're in the middle of the page, you leave 1.5. We leave a space where we are going to write other details. Remember, you're going to record the initial measurements. Then you're going also to talk about subsequently what should be done. Okay, so I'm going to leave a space. Then I do my appendix. My appendix 1. So appendix 1, what are you going to talk about? You're going to talk about initially, okay? Initially, what should be done? How can you get the lease liability? Initially, our lease liability is equal to what? Is equal to present. I believe by now you know. Present values of minimum lease payments, what you're paying, plus present value of what? Of guaranteed residue value. Then plus the present value of the purchase price, of the purchase cost. Present value of the purchase cost. It doesn't mean that you always have this. Like in this question, you don't have the guaranteed residue value, you don't have the purchase cost. Purchase cost will always come if there is an option to purchase. If this lessee has an option to purchase, maybe in the contract they can put the purchase cost. If you find that you have a purchase cost, then you also have this. Then residue value, I said that obviously this is the money you are going to pay to the lessor. You are using his asset. By the time you're returning back, that asset has lost value. Okay, and the lessor want to be compensated. However much you're paying minimum lease payments at the end of the year, but by the time you take back that asset, it has lost some value. Okay, and the lessor wants to be compensated. That's why in the contract you'll find that you have this residue value. Okay, but however, some contracts do not have this. Okay, like this one. So it means that with this question, we need minimum lease payments. We need minimum lease payments. What are we paying and when are we paying? Okay, so how do we get minimum lease payments? From this, I can summarize minimum lease payments. When you check from our note, we are told that the lease required LB to initially make rental payments. These are minimum lease payments of shillings 50 million per annum for the first 3 years. So you first talk about that for the first 3 years. Here you have 50 million. I'm just summarizing for the first, it's 1 3 years. 1 3 years. And obviously you're going also to make another payment. Another payment is shillings 30 million thereafter. After 3 years, you will be making a payment of 30 million, not 50. Okay, so you have 30 million. 30 million for what? For which years? This lease term is for how many years? This term, let's see, 5-year lease. Okay, so it means that this one is for the 4th year and the 5th year. So how are you going to get the present value? How are you going to get the present values of your minimum lease payments? Remember here, payments are made at the end of the year. You can bring your years, then you put your minimum lease payments. Remember, I said you can put minimum lease payments. You put stroke guaranteed residual value, then stroke purchase cost, depending on the question. But here we have only minimum lease payments. Then you look for the discount factor. Discount factors at what? What is our interest rate from the question? The interest rate is the company incremental borrowing rate is 15%. So you're going to use here 15. %. Then it's good to use years. Let me see. We started on this is 1st January 2020. So you're going to start with 2020, then you go to 2021, 2022, then 2023, then 2020 what? 2024. Count five years. Okay, 1, 2, 3, 4, 5. Because you're starting at the start of the year. That is 1st January 2020. So this one is also inclusive. So in the first 3 years, you are paying 50 million. First 3 years, you are paying 50 in a million. In millions. Okay. Yeah, it's 50. Then from the 3rd year, you will pay 30. Here you put 30. Here you put 30. Then discount factor. Discount factor, you can tell me that you can go to your table. You can go to the table and pick, but This is not annuity. Here you're looking at each year. Here the payment is not constant. Or another shortcut but let me stick to this. Okay, so if you're in an exam, you will be given a table. We have the table. Here you remove those things. We have our table. Our table. Okay. Here you're looking at a single period. You're looking at only 1 year, one period. Okay. If you're looking at only one period, you use the first table. If you're looking at more than one period annuity, then you use the second table. This is annuity. But if you're looking at only 1 year, then you use the first table. 15, you're looking for 15%. Where is it? It is here. First year, it is 0. So you copy from the first year to the 5th year. So copy all these figures from the first year to 5th year. So here it is 0.870. That is first year. Then second year it is 0.756. Then here it is it's 0.66558. Then here it is 0.572. And then the 5th year it is 0.497. And to get our present values, these figures are in millions, so I'm going to say shillings in a million. You multiply, you get your minimum lease payment times this. Then what will be your present value of lease liability? Lease liability will be equal to sum. Get the total. And that is your present value of lease liability. Okay. This is in a situation. That is if minimum lease payments were made in arrears. That's how you get minimum that is how you get the present value of lease liability. Okay. So from here, you need also right of use asset, which is equal to, remember we are looking at initially, which is equal to lease liability, present value. Or you can simply, okay, present value of lease liability, then plus initial what? Initial deposit. Then plus what? Plus initial direct costs. Plus the present value of dismantling costs. Costs. Then minus lease incentives. At least you should know this. Okay. From our question, we have present value of lease liability. That is this 146.227 million. This is a million. Plus, do we have initial deposit? Let me see. We are handling May, okay? Initial deposit. Initial deposit. Do we have? Let me see. The automated teller machine had useful life. Okay. LB spent shillings 20 million to transport. 20 million to transport the automated teller machine from MSL location to LBS premises. This is part of direct costs. If at all there was no lease arrangement, you as lessee, you would not have incurred this amount of money. Okay? So this is direct what? This is direct cost. From the premises of the lessor to your premises. This is transport cost. Okay? And it is part of your direct cost. It is not initial deposit. It's just transport costs. Then you have the cost of installing the machine in the, that is 10 million in the LBS premises amounted to shillings 10 million. Of course, also this is part of your initial, this is also part of your initial cost. If at all there was no this transaction, you as a company, you would have not incurred this what? This cost. So this is also direct cost. It's also direct cost. And also they are telling us that the legal costs incidental to the lease contract were shillings 5 million. It means that also this is direct cost. This is also direct cost. You have to incur, you have to pay lawyers to help you in drafting these what? In these contracts. So this is also a direct cost. So here you don't have, ideally you don't have initial deposit here. This one don't say that this is initial deposit. No. Here, this is not initial deposit. There is required LB to initially make rental payments of shillings 50 million per annum for the first 3 years. These are just the minimum lease payments, what you're supposed to pay every year. So this is not initial deposit. If it is initial deposit, they will clearly bring that maybe at the start, the lessee incurred this amount of money. So we don't have initial deposit, so it will be 0. Here it's 0 plus our direct costs, our initial direct costs. We have 20 million plus 10 million. Plus what? Plus 5 million. – 20 million transport costs, 10 million installation costs, then 5 million, this is legal fee. Then plus, we don't have the cost of the dismantling costs. Here the examiner has not stated this. But if you realize that you have the dismantling costs, maybe at the end of the lease term, then you get the present value. Okay, but here we don't have dismantling costs. Remember, if you have dismantling costs, that cost will come at the end of lease term. So you need to discount using the cost of capital. You don't discount using the borrowing rate or the rate impressed in the contract. No. You use the cost of capital in the books of lessee. Okay, we don't have lease incentives. Lease incentives could be you made some payments and maybe there is some reimbursement. The lessor is paying back some money. There it could be what? It could be there is incentives, but we don't have. So if you add, what do you get? If you add, do you have shillings? If you add 181.27, try to add and see. So it means that you are done. You come back to your to your report and do the initial entries. Initial entries, what are you going to debit? You debit right of use asset. Right of use asset shillings, how much? Right of use asset shillings, this one. Then you credit there is liability. There is liability. There is liability, how much? There is liability, it's this. Shillings 146.27 million. What else can you credit? You credit, let me see, you credit now your cash or bank, because you incurred, you as lessee, you incurred these initial direct costs. You incurred initial direct costs, so your bank balance, your bank amount will reduce, so you can credit bank or cash. Shillings, if you add your initial direct costs, even if you have initial deposits, because there you also include, but here it is 20 plus 10 plus 5, that is the 35. 35 million. Okay, and that's all. The debit side must be equal to the credit side, and that's all. Okay, so you are done with initial recognition, initial measurement. Okay, so you're done with that. Then we look at the next part, that is subsequently what should be done. Still in your report, you're going to say that subsequently, what should be done? Subsequently, subsequently, lease liability should be amortized, over, what did we say? Over the what? The lease liability should be amortized over the lease term. Here, as a must, it must be over the lease term, over the lease term or lease period. While the right of use asset should be depreciated, over what? Over the, here there is no option to purchase. So it should be depreciated over the shorter of lease term and the useful life. What is the short? Of course, here the lease term will always be the shorter. So if there is no option to purchase, you depreciate your right of use asset over the lease term. If there is option to purchase, you depreciate right of use asset over the useful life. So here we should depreciate our right of use asset over the lease term. Here 5 years. Okay. Then you tell the examiner that you refer to what? Refer to the appendix, because now in your appendix 2, you're going to talk about, you're going to amortize the lease liability. You also depreciate right of use asset. Refer to appendix 2. And from your appendix, you will be in a position to know what should be reported. Remember, we want to account for this transaction. What should be reported in our financial statements for the year ended 31st December, for the year ended 31st December 2020, we want to see what should be in our financial record. So from my appendix 2, I will also say that for the year ended 31st December 2020, this lessee JB should recognize the following. Okay, so I will get what should be recognized from my appendix 2. Okay, my appendix 2, appendix 2, we need what? First of all, we are looking at the subsequently. Okay. Subsequently, we want to, you can start with any. The easy part is to start with right of use asset. With right of use asset, we are saying that you depreciate over the lease term. So the depreciation of right of use asset will be equal to, you get the cost divided by lease term. So the cost is how much? The cost from your initial amount, the right of use asset is this one. You get this figure, then you divide it by what? How many years? Lease term. 5 years. Divide by 5 years. What do you get? What do you get? This will be shillings. Tell me, colleagues.
36.254.
36.254. 254. You can round off to 1 decimal point or 3 decimal points. So that is the depreciation. Remember, we want the value of an asset that should be recognized in a balance sheet as at 31st December 2020. So you will need to get carrying value of right of use asset as at 31st December 2020. You look at now here when you're doing this, look at the required part. So our required part, we are interested in this, okay? So how do you get the carrying value? You get the cost. This will be the cost. This will equal to the cost minus accumulated depreciation. Okay, so the carrying value will be equal to the cost of right of use asset is 181.27 million minus open bracket the depreciation, that is 36.254 times the number of years from the time you recognize this asset to the time you're preparing this your financial statement. How many years? So here it's, I think it's only 1 year here. Yeah, it's only 1 year because you see we entered into this agreement on 1st January 2020 and we are preparing the records for the year ended 31st December 2020. So here only 1 year. So you're going to multiply by 1 year, the accumulated depreciation. What do you get? You just place all these figures on your calculator. What do you get?
$145.
You get 1 shillings, 145.016 million. That's what you can. That's what you're going to report. Okay. I can come here and I say, for the year ended 31st December 2020, JB should recognize the following. 1, from my right of use asset, I am going to recognize what? I'm going to recognize right of use asset at its carrying value of shillings, of shillings 145 point, this one 145.016 million as a non-current asset in the statement of financial position. Because here you see that here they didn't say you, there is a difference, colleagues. Here you are just accounting. You are not preparing drafts. You are not preparing draft. There is a difference. If you're preparing draft financial statements, then you need to bring this. You need to extract the statement of financial position. Then you list item that will appear in the financial statements. But here we are just accounting. So if you're accounting, you don't need to do extracts. You just report. You just report. Okay, you just report what should appear in balance sheet, what should appear in income statement. Okay, so here in our balance sheet, we will have right of use asset. Then next, of course, you know that depreciation must be also recognized in the income statement. So you will also say that depreciation expense of shillings, each year the depreciation is this. Depreciation expense of shillings 36.25254 million as an operating expense in the profit or loss account. Okay, that's all about an asset. So you also look at what? You also look at liability. For liability, we are saying that you amortize the liability should be amortized. So what you need here, amortize the lease liability over how many years? Over 5 years. Over 5 years. But it doesn't mean that your amortization schedule will include all the 5 years. It all depends on the what? On the question. Amortization schedule of lease liability. So here we'll put here years. Then you can put balance. Remember here we are looking, this is payment in arrears. Okay, so here you start with balance brought down. From balance brought down, you put interest at what? This interest is at, is it at 15%? Okay, then from there you are going to put minimum lease payments. If you have residue value, you also put residue value, guaranteed residue value. If you have also purchase option, you put all that. But you must be knowing when will that transaction happen, in which year. Okay, but here we only have minimum lease payments. Then from there, you are going to put balance carried down. All our amounts in millions. So from here you start. You need 2020, that because that is the first year, 2021. Now, always look at the time. Look at the time you're preparing records. Of course, you need 5 years. You're amortizing. This is amortization schedule for 5 years, okay? But I don't need all the years for exam purposes. For exam purposes, I don't need all the what? All the years. I need the first two. I need, for this one, I need the first two for exam purpose, okay? To help me to know what is non-current liability and current liability. That's why you need the other year, the following year, okay? So the balance brought down, initially what was your liability? It is 146.27. Out of this, you're going to pay an interest of 15%. Then minimum lease payments, 2020, 2021, you're paying 50. You're paying 50. This should be in bracket. Even year 2, you're paying 50. Even year 3, you're paying 50. But from year 4 and year 5, you're paying only 30. Don't forget that. If at all we are preparing maybe records for the year ended 31st December 2024, you should be knowing that in your mind, the minimum lease liability in 2024 is, let's say, 30 million. But here, you're still dealing with what? Is 20. So how do you get the balance carried down? You get this plus interest, then minus your minimum lease payments. Then here, this figure will act as your the balance carried down of the previous year will act as the opening balance of the next year. You do the same here, 15% times your opening balance, and here you get your balance brought down plus interest, then minus minimum lease payments. You need only these two for exam purposes. But if you may be in a company, you just need to do everything from 2020 to the last year. 2020, 2021, 2023, 2020, 2022, 2023, and 2024. Here. 2022, 2023, and 2020, 2024. At the end here, the lease liability must be 0. It must be 0 here. It must be 0. Okay, it must be 0, but I don't want to waste time. But if you do, it will be 0. It will be 0 if you want to prove. But this is all not required. Here you bring this, then the interest is 15% times this. Then here you're just adding. Then here you bring this. Then times 15% times this. Then here it's this. Then the interest 15% times this. So at the end it should be 0. This one, what you're seeing is just because of decimal points. At a whole number, you get 0. You get. So At the end, it must be what? It must be 0. But for exam purposes, you just need to know when are you preparing, when are you preparing financial statements. So from this, I need to know what should be reported in my financial statements. One, you will need non-current liability. I'm going to summarize, but you don't need to write these ones here. These ones will be recognized here. Let's try to analyze this amortization schedule. Your non-current liability will be what? Remember, you're preparing records for the year ended 31st December 2020 here. So it means that my long-term, my non-current liability is this one, 86 million. The next figure here from this. Then your current liability is this one in 2020 minus 86. That is your current liability. Then interest cost. Remember, you're paying interest cost. What is interest cost in the year you're handling? That is 2020. The interest cost is 22. Then what else? Minimum lease, the one that will go to cash flow statement, is what you're paying. What you're paying every year. So let's recognize. I will say that the interest expenses, interest cost of shillings. Tell me, was it 22 million as a finance cost account. What else? Lease liability of shillings. Lease liability of shillings. The one in the this one in 2020. This is the lease liability. 118 million.
You're off.
Okay, sorry about that. Are you now in a position to hear me?
Yes.
Someone to confirm? Okay, where are we? Let me see. Where are we? We are okay. There is liability of shillings. This must be split into current liability of this and the non-current liability of shillings, 86 million as liabilities in the statement of financial position. Then finally, another item that you must state is minimum lease payments of shillings in 2020. What is minimum lease payment? 50. This 50 must be reported in your cash flow statement. Minimum lease payment of shillings 50 million as cash outflow towards financing activities in the statement of cash flows. And that's all with that note. That's all